Good morning, everyone. We'll just give it a minute or two just to let people join. And as we're waiting, and before I get into the actual content of this presentation, there are a few administrative items I'll just deal with. So just as a reminder, if you're looking for CPD credit, just send an email to the email address in the invitation to this presentation and submit any written questions you have through the Q&A feature. And we'll try and address as many of those as we can at the end of the presentation. So thank you for joining us for our third session on corporate M&A transactions, our focus on the role of the tax group in the life cycle of the transaction. So today we will be talking about common issues to consider in structuring a transaction. I'm just going to sort of start off where Anthony and Sarah left off last week. Then I will hand you guys off to Matt, who will deal with protecting privilege throughout a transaction, and then he'll touch on some select tax elements of a purchase and sale agreement. And then we'll get into a brief current topic with Chris, who will give an update on transfer pricing. So Anthony and Sarah started the last session with some considerations when a purchaser is acquiring the target's assets. They then went on to deal with transactions that are structured such that the purchaser is purchasing the target's shares. So as I mentioned, I'm going to start off sort of where they left off and just discuss some additional planning issues when a purchaser is acquiring the target's shares. So we're going to start with a really simple fact pattern here. We're going to have a purchaser that's a public corporation. And then we're going to have a target that's a CCPC, all of the shares of which are owned by a holdco. And just to give some really simple numerical information up there, there's no basis in the target shares or the target's asset, which in this case is just goodwill. So in our fact pattern, we have a pubco purchasing the shares of a CCPC from a holdco. So when the purchaser and the target sign a purchase and sale agreement, there are some specific consequences because of the target's status as a CCPC. So when that purchase and sale agreement is signed, the target actually ceases to be a CCPC. So very generally, the definition of a CCPC in subsection 125.7 deems a corporation not to be a CCPC if it's controlled by a public corporation or a non-resident. So in our case, we have a purchaser who's a public corporation. And under the purchase and sale agreement, the purchaser has the right to acquire all of the shares of the target. But in determining who controls the target for purposes of the CCPC for the CCPC definition, we have to look at rights under 251(5)(b). So 251(5)(b) states that those rights, such as those of a purchaser under a PSA, should be treated as having been exercised for the purposes of applying the CCPC definition. So in our case, since the purchaser has a right to acquire all of the shares under the purchase and sale agreement, the moment that that PSA is signed, we need to look at those rights as having been exercised and the target ceases to be a CCPC. And it's important to note that those 251(5)(b) rights don't affect the capital gains the capital gains exemption under 110.6. So there are some consequences that are fairly important when a corporation ceases to be a CCPC. So there's a deemed tax year end prior to this change of status, but more importantly, subsection 89.8 provides for an addition to a corporation's LRIP account when the corporation ceases to be a CCPC. So a fairly complex calculation, but at a very high level, you can describe that LRIP addition as the amount by which the cost of property, money, and the corporation's losses exceeds the corporation's debt, PUC, and GRIP. So because of how that's worded in 89.8, a high GRIP helps reduce the addition to the corporation's LRIP when it ceases to be a CCPC. And we'll come back to that in just a moment. So here are some very common transactions that you will see a vendor wanting to do before the sale actually closes. So fairly typical, the vendor would want to pay a capital dividend before the sale and any safe income dividends if the shareholder is a corporation. And though that's pretty simple and straightforward, the vendor should be mindful of any reps and warranties they gave in that purchase and sale agreement in respect of any tax balances and the payment of dividends. So it's quite common for the purchaser to want the balances of certain tax amounts to be represented in the purchase and sale agreement, and those tax balances could include the CDA and could include safe income. In addition, the purchaser may have requested a restriction on the payment of dividends by the target before the sale. So the vendor will just want to check any reps or warranties they made just to make sure that the fairly simple planning of paying capital dividends or paying up safe income dividends is not offside the purchase and sale agreement. In addition, the vendors should look at the target's dividend policy, if any, just to make sure, again, that the payment of those dividends is not offside that policy, if there is one. So now just some purchasing or some considerations from the purchaser's perspective. The purchaser may not want eligible dividends paid out before the status change of the target because eligible dividends reduce GRIP. So as I discussed, when the target ceases to be a CCPC, there's an addition to the LRIP balance. And generally, GRIP is a good thing under that formula, as I mentioned, that high GRIP, because it results in a lower LRIP balance. So why does the purchaser care about this? Well, it depends on the circumstances, but this could be relevant to any subsequent transactions that the purchaser may want to take in respect of transferring assets or cash out of the target. The purchaser will want the target to have a low LRIP balance because then they'll be able to pay out eligible dividends sooner. So the target will not be able to pay the target will not be able to pay eligible dividends until that LRIP is eliminated. And this is an important consideration for the purchaser if, again, they plan on making any transfers. And if eligible dividends are paid out while there is an LRIP balance, there are penalties. So back to sort of this example we have where we have the target ceasing to be a CCPC on the signing of the purchase and sale agreement. And then subsequent to that, we have the purchaser acquiring the target shares on the closing date. So there are many forms of planning. I'm just going to walk through at a really high level an example that's increasingly common to see when you have a public entity or a non-resident entity buying a CCPC. So because of that timing between when the target ceases to be a CCPC and when the sale occurs, there are ways to take advantage of the target's ability to be taxed at non-CCPC rates. So I've just put in some dates as an example here. Closing date is typically after signing the purchase and sale agreement. Here, I've just made that 1 week. So 1 week before, the target and purchaser will sign the PSA. At that moment, the target ceases to be a CCPC. We'll have closing, the closing date a week later. There will be an acquisition of control at the beginning of the day. I will get into that in more detail, don't worry. And then at the closing time, I've just chosen 2 p.m. on the closing date. Then the purchaser actually acquires the target shares. So here's an example, one of many of ways you can take advantage of that timing. So there's an acquisition of control that's deemed to occur at the beginning of the day, unless there's an election filed such that the acquisition of control would occur at the closing time. So in our example, 2 p.m. But no election will be made for the purposes of this planning. Also important to note that there's a deemed year end before the acquisition of control. So in our case study, we've now had 2 deemed year ends. We've had on the CCPC immediately before the change in status, CCPC to non-CCPC, and now we have one immediately before the acquisition of control. So when there is an acquisition of control, paragraph 111.4e permits a taxpayer to designate certain capital properties to be deemed to have been disposed of and reacquired subject to certain restrictions. But at a very high level, the designation permits the target to increase the ACB of its asset, in our case, the goodwill, up to the extent that the fair market value exceeds the target's ACB. So in our case, we can bump up the ACB of the goodwill to $100. So what are some of the other consequences of this designation? Well, the target will realize a disposition of its or deemed disposition of its goodwill, which will result in a capital gain of $100 and a taxable capital gain of $50. This will be reported in its acquisition of control return. So here's the important part, that since the target is a non-CCPC, that taxable capital gain will be taxed at 23% compared to the CCPC rate of 46.67% approximately. So this results in tax payable by the target on that capital gain of about $11.50. So the target should also be deemed to have reacquired the goodwill at that capital cost equal to $100, but just note that the target can only depreciate half of that capital cost when the designation is made, and that's paragraph 13.7f. So what else happens? Well, in addition, there's going to be an addition to the CDA account of the target for the non-taxable portion of the capital gain. So in our case, we're going to have an addition to the target CDA balance of $50. The target safe income on hand should increase by the taxable portion of the capital gain minus any corporate income tax payable. So in our case, $50 less that $11.50, we get safe income on hand in addition there to $38.50. And then these are the transactions that will happen on the closing date. So now we have a target that has CDA and safe income amounts that can be paid out to Holdco tax-free as a dividend. It's two separate dividends. So on the closing date, after the acquisition of control, which happened at the beginning of the day, but before the closing of the sale, Target will pay out those dividends with a note. So in that case, the fair market value of Target should be reduced to zero because you're going to have that note owing for those dividends of $88.50. And then Target still has that tax liability that arose on the disposition, the deemed disposition of the goodwill. So that makes the fair market value of Target zero. So the result there are tax-free dividends paid up to Holdco and no capital gain on the sale to Target. So this results in a deferral at the Holdco level. Future tax will be payable when dividends are paid out by Holdco to that resident individual or when the shares of Holdco are sold. But there's still a deferral, and it's either small or large. You will either have small or large absolute tax savings at current rates, sort of depending on the timing and depending on how those dividends or the sale is structured down the line. So parties should also be mindful to deal with any stock options that the target has outstanding. There are generally three ways that you can deal with the stock options of the target. The target can, or the options of the target can just be exercised and shares of the target can be issued. The purchaser can issue options in exchange for the cancellation of target options, or you can just cash out the options. So I'll go through each of those at a very high level. So exercising the target options, it's typically one of the simplest ways to deal with the stock options. So when that option is exercised, the employee crystallizes that taxable benefit. And for CCPCs, that income inclusion is deferred until the shares are disposed of. So where the target is a CCPC, whether this income inclusion can actually be deferred will depend on the structure of the sale transaction. So if the purchaser is just paying cash for the target shares, there won't be no deferral because you will have the options being exercised and then those shares of target being disposed of in the same year. But if the purchaser is issuing shares of the purchaser as consideration for acquiring shares of the target, there could be a deferral. So subsection 7(1.5) allows the deferral to continue where the target shares are exchanged for the purchaser shares. The provision essentially deems there to be no disposition there. So further, subsection 7(1.5) will deem the shares of the purchaser to be the shares of the CCPC for purposes not only of applying section 7, but for also paragraphs 110(1)(d) and 110(1)(d.1). So the employee may later be entitled to rely on that deduction under 110(1)(d.1) in the case of a CCPC, provided the other requirements are met, such as that 2-year hold. So another way to deal with options is just to have the purchaser issue options in exchange for the cancellation of the target's options. So generally when an option under subsection 7.1 is exchanged for another option, the taxpayer would typically be considered to have disposed of the option. However, subsection 1.4 could provide a deferral. So if the requirements of that provision are met, the new option, the purchaser option, is deemed to be the same as the old option, the target option, and the new issuer, the purchaser, is deemed to be the same as the old issuer. So at a really, really high level, in order for that exchange to be deferred under subsection 7(1.4, the option holder can only receive consideration that is the new option, so no cash, for example. And there needs to be no increase in economic value of the new option when compared to the economic value of the old option. So, and then it really at a high level, that just means there can be no additional in the money amount of those new options. The third way to deal with stock options, perhaps seems the simpler one, but could have some adverse consequences if you are not careful, is just to cash out the option. So in that case, you only pay out the in the money amount. So for example, if an option has an exercise price of $1, the market value of the share is $2, you just cancel the option and pay out that in the money amount of $1. But the cash out of the option creates a taxable benefit under paragraph 7(1)(b) rather than 7(1)(a). And that's because the holder is not exercising the option, but they are disposing of their rights under the option. So a paragraph 7(1)(b) benefit is generally not subject to the deductions under 110(1)(d) or 110(1)(d.1), and that's because no shares are actually being acquired. However, the 110(1)(d) deduction could be available if the employer elects under 110(1.1) not to claim a deduction for that cash out payment. and it must provide the employee written evidence of that election, and then the employee files that evidence with the CRA. So now this election under 110.1.1 only provides access to a deduction under 110.1D, not D.1. So provided all of the other requirements of 110.1D are met, the taxpayer should be entitled to the deduction. So just as an example, if the option was initially issued in the money, the deduction under 110.1D would not be available. So just be mindful that even if an employer makes that election, just make sure you go through and make sure all of the other requirements of 110.1D are there so that the employee can actually claim that deduction. And another important consideration is that if this election under 110.1.1 by the employer is being relied on, just to consider documenting the target's responsibility to do that in the corporate documentation, because it could be months before the target actually issues the T4s to the employees, and you just want to make sure that the requirement to make this election is not missed down the road. So now we're going to sort of exit the realm of CCPCs. We're going to have some slightly revised facts. Same purchaser situation, but we're going to have a target that's now a pubco and its shares are listed on the TSX. So following the purchase of target, essentially there will be two stacked pubcos. Generally, it will not make sense for the target to remain a public corporation. So the target will have to make an election not to be a public corporation and provide that to the CRA. But in our case, since the shares of the target are listed on the TSX, the target will not be eligible to make that going private election until the shares are delisted. So once the TSX has confirmed that the shares are delisted from the TSX, the target will file a going private election, that's form T2067 with the CRA. It's generally best practice just to make that election as soon as possible, so as soon as those shares are delisted after the acquisition, because it can affect a target's ability to return capital to the purchaser tax-free. And I'll go through a really quick example on the next slide of that. So in this example, immediately following the acquisition of target, the plan is for target to distribute asset A up to purchaser as a return of capital. In our case, we're just going to make the assumption that purchaser has basis and PUC in the target shares that exceeds the fair market value of asset A, such that typically, absent this 84.4.1 issue, asset A could be distributed up tax-free. But prior to making that going private election, target will be unable to return capital on a non-taxable basis because it will still be a public corporation. So, subject to certain exceptions, subsection 84.4.1 provides that any amount paid by a pubco on the reduction of its PUC will be deemed to have been paid by the corporation and received by the recipient as a dividend. So this is a departure from that normal rule where PUC can be returned to a shareholder tax-free. So because of our timing that we addressed in the last slide, where the shares of the target need to be delisted first, that's not going to be instantaneous. You will need to wait for confirmation from the TSX before the target is eligible to file that going private election. And since the plan is immediately following the acquisition to distribute those assets, at that moment in time, immediately after the acquisition, target will still be a pubco. So this is just something to be mindful of. The distribution of the asset can be structured differently so that 84.4.1 doesn't apply. You could do it as a redemption of target shares, or you could just wait until target's not a pubco. So it's easy to solve. It's just not a trap you want to fall into. So I thought I'd sort of wrap up our considerations for the target purchasing, the purchaser purchasing shares of target with just some high-level best practices in managing a deal. So planning should start while the sale is at a conceptual stage and wait before the actual implementation of the deal. And the tax team should be involved as early as possible, and tax should really be an integral part of the deal team. So effective planning early on is key to mitigating future tax audits and disputes. So some best practices include obtaining a tax memorandum, or at the very least, a detailed transaction step memo, documenting the transaction according to that tax memo, or at least according to those steps that you guys have listed out, and then ensuring that the transactions are legally effective so that the documentation does legally affect what is intended. And everyone should be sure to keep up-to-date checklists of issues, compliance obligations, etc. Just as an example, we recommend diarizing every filing deadline. For example, you could get into a situation you have several deemed year ends. In our first case study, we had 2. So just making sure you diarize all of that, all of those filing deadlines, elections, tax returns, etc., and who is responsible for doing that. So now I'm going to hand you off to Matt, and I will be back to answer any questions, if there are any, in the Q&A following Chris's last part of the presentation.
Good morning, everyone. Thanks, Erica. As Erica mentioned earlier, I'm going to be speaking about two things this morning. First, I'm going to speak about protecting privilege throughout an M&A transaction, and then I'm going to discuss some very select elements of a purchase and sale agreement, tax elements of a purchase and sale agreement. So when you're getting started with an M&A transaction, it's very exciting, and the commercial components of the deal are what are on people's minds. And it's the last thing on your mind at that point is an audit of the transaction that will be 4 or 5 years down the road. So that's usually not top of mind at that time. But it's really important to think about how you're protecting privilege at that stage of the transaction, because doing things properly at that point in time can make a big difference in how the audit in the future will proceed. It's really important in those early days of a transaction to make protecting privilege a priority, to talk about it with your team, to put in place good processes, because all of those things make a big difference down the road when you're trying to rely on privilege to not have to disclose a document to the Canada Revenue Agency. The first step in protecting solicitor-client privilege is having a really clear sense of what it is and what communications, which documents will be protected by solicitor-client privilege. The Supreme Court has weighed in numerous times on solicitor-client privilege and has articulated that it's a principle of fundamental justice, and that it should be jealously guarded and only set aside in the most unusual circumstances. Sort of when you think about privilege more in a criminal law context or a family law context, it's kind of apparent, it's clear to and easy to understand how important it is for our society, for the well-being of our society, that clients are able to candidly communicate with their lawyers and seek legal advice without the risk of it being disclosed. And so that translates over to tax law as well. The privilege belongs to the client. Only the client can waive the privilege, and lawyers have a professional duty to protect clients' privileged communications. There's 3 conditions for communications to be privileged, and I'll make a few comments about each of these conditions. So the first is that communications must be between a client and a solicitor. Often there's some communications with third parties in the course of obtaining legal advice. In the tax context, often we'll have accountants involved and lawyers involved, and to the extent that the accountants act as interpreters of the advice or providing information for the purpose of obtaining the legal advice, then those communications with the third parties can fall under the umbrella of communications between a client and a solicitor. The second condition is that the communications must be made during the course of seeking or giving of legal advice. And one of the distinctions that comes up a lot, and you'll see this in the Atlas Tube case that I'm going to discuss in a few moments, but there's often a distinction between business advice and legal advice. And communications for the purpose of seeking or giving business advice would not be subject to solicitor-client privilege and protected. So sometimes it's important to kind of make sure that you're describing the communications properly as for the purpose of obtaining legal advice. One of the times this comes up quite frequently is with in-house legal counsel, who are wearing numerous hats in the course of their day, and at sometimes they're giving strictly business advice and participating in business decisions. Other times they're being asked to provide their legal advice and perspective on those business decisions, and those might be solicitor-client privilege. But it's sort of important to understand which hat is being worn at a particular time. And the third condition for communications to be subject to solicitor-client privilege is that the communications and the parties intended for those communications to be confidential. And this is sort of where waiver of privilege by disclosure to third parties comes in. If you disclose a document or a communication to a third party, there can be an implied waiver of privilege, and what it's really getting at is you must not have intended for this communication to be confidential since you're sharing it with others. So going into that concept of waiver a little more deeply, again, privilege belongs only to the client, and only the client can waive privilege. And sometimes when you're waiving privilege, you'll do so explicitly. In the course of an audit, you might say, look, it's in our interests to disclose some communications that, yeah, it's a tax memo, it is subject to solicitor-client privilege, but we're explicitly waiving privilege in this circumstance because we think it advances our interests in terms of resolving the audit. Or there can be an implied waiver of privilege, and disclosure of document to a third party is an implied waiver of privilege. There's an exception to that waiver, and that's common interest privilege, and it gets really important in the context of an M&A transaction. So common interest privilege isn't really its own head of privilege, it's an exception to the waiver of solicitor-client privilege. So where a document is subject to solicitor-client privilege and two counterparties to a transaction have a sufficient common interest, then they can share documents with one another that are privileged, and that will not constitute a waiver of the privilege. If a document isn't subject to solicitor-client privilege in the first instance, then common interest privilege doesn't extend the concept of privilege to capture that document. It has to be subject to solicitor-client privilege in the first instance, and it's just that by sharing it, you're not considered to have waived privilege. So the CRA has recently challenged the existence of common interest privilege, and it was in the context of an M&A transaction. And in Iglis Holdings, there was a legal opinion that described the tax consequences of each step of the transaction and identified certain tax risks. And the counterparties to the transaction actually produced this memo in coordination. The tax advisors to each party participated in and contributed to the drafting of this legal opinion. And at the federal court found that common interest privilege is not a valid component of solicitor-client privilege. So it was a bit of a shocking outcome to many of us, and it was seen as a real change in the landscape of privilege. Fortunately, the decision was appealed to the Federal Court of Appeal, and the Federal Court of Appeal was very clear that common interest privilege does exist. It's strongly implanted in Canadian law, that it's an exception to the waiver of privilege, and clearly said that solicitor-client privilege is not waived when an opinion provided by a lawyer to one party is disclosed on a confidential basis to other parties with sufficient common interest in the same transactions. So usually when you're working on an M&A deal, there will be the opportunity to say, look, we have a sufficient common interest in closing this transaction, sharing certain privileged communications with one another and certain other confidential information with one another will help us advance the transaction, advance the negotiations, and doing so is not a waiver of privilege. Often in an M&A context, that common interest privilege will be formalized in the form of a confidentiality and common interest privilege agreement. And this is put in place to formalize the exchange of documents and try to protect privilege to the greatest extent possible. So when your tax group is working on a transaction and there's a common interest privilege agreement in place, you should have a copy of that agreement. You should review a copy of that agreement. You should be consulted in preparation of that agreement. And then you should keep a copy of it with the rest of your privileged communications. A common interest privilege agreement will typically delineate circumstances where disclosure to, say, the CRA is permitted. Will limit how you can use the confidential information that is exchanged under the terms of the common interest privilege agreement. And really, it's usually limited to only for purposes of advancing the transaction that you're working on. And then there will be some procedures where disclosure is requested or required. So 4 years down the road, when the CRA comes in and audits this transaction and requests certain documents from you, your disclosure of those documents and that request will typically, you'll have particular obligations with respect to that under the common interest privilege agreement. So it will be important then to be able to pull out a copy of that common interest privilege agreement and say, what are we required to do here? And usually that includes notifying the other party, consulting with the other party as to the scope of disclosure, disclosing to the minimum extent permitted, and asserting privilege on behalf of the other party. So you'll have some obligations under this common interest privilege agreement. It's important to really understand what's in there and to have access to a copy of it when down the road you're being audited and disclosure is being requested. So just to run over some sort of best practices for protecting privilege as you're working throughout the transaction. So we recommend keeping all your privilege documentation separate from other documentation, keeping in a separate folder, a separate binder, or set of binders, and having them clearly marked privilege, so that down the road you limit the inadvertent disclosure of those documents to the CRA, that everyone knows what's privileged and what's not. Internally, you're often the tax group is often sharing advice that they've received with executives that are making the decisions about whether to go forward with the transaction or not. But in those sort of internal consultations, it's really important to limit the circulation of privileged documentation. If a privileged memo ends up being widely circulated, the risk of inadvertent disclosure down the road really goes up. So what we recommend is things like when you're going to a meeting with your executives, print out copies of the slide deck or the memorandum, share them with people, and collect them at the end of the meeting where possible. I mean, that's not always going to be realistic, but where possible, really limit the circulation of those privileged documents. When you're preparing your notes about the advice given or summarizing the tax risks that have been identified, right at the top of your notes, privileged, and describe the basis for privilege on those notes. This is a summary of legal advice received from this lawyer on this date. That really helps you down the road when you're asserting that the document's privileged. Also, for your internal memorandum, sometimes you'll say prepare a memo that describes the transactions that the commercial group has told you they're planning to undertake. And you'll have done a preliminary, here's the transactions, here's some facts, here's some risks that we're seeing, and then you'll send that to your legal counsel to get their input on it. Right on that document, you should be, take a step back, because you produce a document, it's not privileged. It's only privileged when it's communication between a solicitor and a client. So, but where you're sharing that internal memo that you've prepared with your legal counsel for the purpose of obtaining legal advice, that internal memo should then be subject to privilege. But it's better if you can write right on that memo, prepared for the purpose of obtaining legal advice from this lawyer on this date, and really describe the basis for privilege on that internal memo. And same goes for all your internal communications. Sometimes an email that you're sending to your CFO will contain and be a summary of legal advice you've received. Where that's the case, say it right in the email. Say privileged and confidential and why, and then carry on with the substance of the email. There's a recent decision, another recent decision from the federal court, Atlas Tube. And it's worth being very aware of right now. And it surrounded a due diligence report, a tax due diligence report that was prepared by an accounting firm and in connection with the transaction. And so the tax due diligence report described the target's tax profile and attributes, it described some material tax exposures from previous filings, and it included an evaluation of the target's reserves. In this case, the report was commissioned by the client on the recommendation of the legal counsel that was driving the transaction, and the report was provided to the legal counsel. And the minister applied to compel disclosure of the report under section 231.7. And the Atlas argued that the report was protected by solicitor-client privilege. Good news from the decision is that the federal court clarified and confirmed that where a third party, in this case the accounting firm, functions as an interpreter of information provided by the client for the solicitor, or serves as a conduit of advice from the solicitor to the client, or employs expertise in assembling information provided by the client and in explaining it to the solicitor, those things can be privileged. Those communications can be privileged. So that's helpful in the sense that just because it was prepared by an accounting firm didn't mean that it wasn't privileged. If it was a conduit, interpreter, expertise in assembling information, one of those sorts of heads, then the communication could still be subject to solicitor-client privilege. But the court then went on and said, in a due diligence process, some of what you're looking at is business advice, and some of what you're doing is providing legal advice. And so just a due diligence report in and of itself is not inherently privileged. You have to show that it was communication for the purpose of obtaining legal advice. And in this case, there was some unfortunate evidence out there, and the court ended up finding that the dominant purpose of the due diligence report was to inform the decision whether to proceed with the transaction and at what price, and that was inherently a business decision, and so that this was business advice and not legal advice. And for that reason, that the due diligence report was not protected by solicitor-client privilege. So that was the federal court's decision. Atlas appealed that decision to the Federal Court of Appeal. And while they're waiting to hear that appeal, the parties ended up settling the tax dispute. So that appeal will never be heard, and this federal court decision hangs out there, unfortunately. So what can we take away from the Atlas Tube decision? First, I'd say that with respect to the federal court, there's some real flawed reasoning in the federal court decision. First, the idea that legal advice and business advice can be so easily segregated just isn't realistic. The legal advice, the due diligence report contained legal advice. It identified legal risks, and the idea that it's just a go or no go decision on the transaction just isn't realistic. The legal advice in the due diligence report would impact drafting of reps and warranties in the agreement. It would impact an assessment of legal risk going forward, and how prepared you need to be for certain legal risks that are coming in the future. And the legal decisions and the business decisions are just inextricably intertwined. And so it doesn't seem right to me to try to separate them and create a false distinction between business advice and legal advice in the context of a due diligence report. They're all one and the same in that context. The court also raised this idea that the dominant purpose of the communication needed to be legal advice as opposed to business advice. And that dominant purpose concept is imported from litigation privilege. So when you're preparing documents in contemplation of litigation, in that context, the document is only privileged if the litigation is the predominant purpose for producing that document. That dominant purpose concept doesn't really come from solicitor-client privilege world. It's the litigation privilege. It's a different head of privilege entirely. In the solicitor-client privilege, any communication for the purpose of obtaining legal advice is privileged. There's no requirement that the dominant purpose be for the purpose of obtaining legal advice. And so that test is not a test that has existed before. So it's new, and I don't think it's appropriate that it was brought in this context. So that said, the decision's out there, and there's some things you can do to manage your facts to improve your position that a due diligence report is subject to solicitor-client privilege. So first, we would recommend engaging a law firm first, and then having an accounting firm engaged to assist the law firm in providing legal advice. In almost all due diligence due diligence processes, you'll need both. You'll need accountants to be providing information, interpreting, assembling, and being a conduit of information, and you'll need lawyers to provide the legal advice that's subject to solicitor-client privilege. But the order of engagement can matter. I would say it's important to be proactive in how you frame your engagement. You're framing this engagement to assess legal risks, to quantify legal risks, to mitigate, to understand what steps you can take to mitigate legal risks around the transaction, and that it's really for the purpose of obtaining legal advice with respect to the transaction. And you can be proactive in how you frame that engagement. And then just being prepared to explain the legal advice purpose of the report. It just seems like in the Atlas 2 decision, it was a little bit fuzzy about what the legal advice purpose of the report was. And there was some bad evidence out there. Finally, at the end of an M&A transaction, it's important to take some time, and we all know how manic and fast-paced these transactions can be, and it's hard to kind of take time at the end of the deal to do this, but it can be really important. This is the time to think about what your files look like in anticipation of the audit that you know is coming down the road, and to put yourself and prepare yourself to have that go successfully. So the first thing, again, we recommend taking your privileged documents and separating them, putting them in a binder, marking it privileged, and having them there. And this limits the inadvertent disclosure, and it puts you in a position where you're prepared to describe why things are privileged and what is privileged. And then preserving some really key documents, things like valuations, contemporaneous transfer pricing documentation, descriptions of business rationale for transactions. Sometimes down the road, 4 or 5 years, your key executives that were negotiating and working on the deal won't be there. And where that's the case, it's important to have the institutional knowledge about what was the rationale for certain steps in the transaction, and to have those memorialized in a way that you can access them easily when there's questions about those things down the road. And then the last thing is that you're required to maintain books and records described in subsection 230 sub 1. But there's lots of documents that will be produced throughout the process of an M&A deal that don't fall under that requirement, and you're not required to maintain them. And in some cases, they're not that helpful to you, and the best thing to do is get rid of them at the end of the transaction, cull your file, get rid of the things that you're not required to maintain and that might not be helpful going forward. And one of the things that we see a lot of is drafts of say a purchase and sale agreement or other documents. There will be numerous turns of the document, and you might have handwritten notes or prior versions that disclose what some of your thinking and legal and what your thinking was around how the transaction evolved. And those are often not helpful, and you're not required to maintain them. And we recommend, unless there's a good reason to keep it, that you get rid of those things at the end of the transaction. Handwritten notes, internal email correspondence. You should turn your mind to all those documents and ask, are we required to keep them? And if we're not required to keep them, are they helpful? And if the answer is no to those things, then now's the time to get rid of them. Okay, I'm going to move on here to some select tax elements in a purchase and sale agreement. And really just this is not comprehensive at all. I've just sort of picked and chose some things that I think are worth discussing here today. So often deals, especially in a climate where it's tough to come to an agreement around value and price, often deals will include a future contingent payment. And future contingent payments often, or earnouts, often fall within paragraph 12(1)(g). And 12(1)(g) applies to include into income any amount that was received that was dependent on the use of or production from property. So if we're looking at performance of an acquired business, often you would say that's if you reach certain performance thresholds, that you'll be entitled to a future payment, and you would say that those payments are dependent on the use of or production from property, and for that reason are included in income, and then rather than being capital receipts. So from the vendor perspective, that puts you in a place where you are having an income inclusion rather than a capital receipt. And from the purchaser considerations, usually that's a payment on account of capital still. So there's a real risk of asymmetrical treatment in with these future contingent payments. And so the tax group should be getting involved, looking at those provisions and thinking about them, and at the very least having people prepared for what the treatment will be. But even better is when you can get involved in the negotiation and drafting, it's sometimes possible to improve that treatment and result in a capital receipt for the vendor, or at least improve the arguments that it should be a capital receipt. And so to do that, what you want to do is tie the future contingent payment to something that's not the use of or production from property. So something we've seen recently was tying it to a resource price. And because the resource price, you wouldn't say that the payment was dependent on the use of or production from property. It was dependent on a resource price meeting certain thresholds. So you may be able to improve your capital receipt arguments. Also, there's some ways to improve the outcome. One of the ways is a reverse earnout if it's appropriate from a commercial perspective. So one of the things you'll be spending a lot of time with in the purchase and sale agreement will be the tax reps and warranties. And there'll often be a boilerplate sort of precedent-driven list of reps and warranties in an agreement, but I encourage you not to be constrained by those precedents. You should really be thinking about your circumstances, the risks that are important to you in the deal, and consider these reps and warranties in conjunction with your due diligence process, because that's where you will have identified which risks are more material or less material, or potential risks that you weren't able to diligence very thoroughly. Well, maybe the reps and warranties in the purchase and sale agreement can be a way of protecting you against those risks. You should really be thinking about, especially on the vendor side, which individual in your organization will be certifying the reps and warranties, and put yourself in that person's shoes. Are you very confident that you can rep as to the truth and accuracy of the reps and warranties that are contained in the agreement? And you may need to add in some qualifiers around knowledge, to the best of your knowledge, these things are true, or materiality, that they're true, to a certain threshold. We often find that some of these reps and warranties that are produced by precedents are more appropriate in smaller organizations where one person will have more intimate knowledge and personal knowledge of the various things that are being repped and warrantied. In larger organizations, that can be really difficult to ask someone to do, that they just won't have that kind of knowledge. And you think about like a really common one that you see in the precedents is, have all the withholdings been made and remitted? And in a large organization, how can someone say that all of the withholdings have been made, that there hasn't been a glitch in the payroll somewhere where someone's withholdings were not properly remitted, or maybe that someone that you've been treating as an independent contractor actually is an employee and you missed some of the withholdings. So you just have to be really careful about that you're not over promising and putting someone in a really difficult situation with the reps and warranties. Another thing for the tax group to get involved in is what the survival period of the reps and warranties is. So typically you will want the reps and warranties to survive until the such time as the issues are statute barred. The issues that you're trying to protect against, the risks you're trying to protect against, are statute barred. And so you have to be alive to whether there's any international issues that would extend the normal reassessment period, and such that you need them to survive a longer period of time. Sometimes people will try to draft using that kind of language rather than putting a precise year count or year survival count on the reps and warranties. They'll try to draft in a way that says, so long as this normal reassessment or until this normal reassessment period expires and these issues are statute barred, that they survive that long. Commercial counsel often doesn't like that, and the clients sometimes don't like that, because they want more certainty about when these reps and warranties are extinguished. So, that's a place where the tax group needs to step in and play a role. It's also really worth thinking about reps and warranties in a merger context, because if you've acquired the entity, and the reps and warranties are being made by that entity, what value are they really in the future? You're not going to sue yourself for a breach of those reps and warranties, and so it's really worth considering whether there's a significant shareholder that can be giving the reps and warranties, and so that there'll be someone to go after down the road if they turn out not to be accurate. So usually with in an M&A transaction, there will be the vendor responsible for preparing and filing returns for the pre-closing period, and the purchaser responsible for preparing and filing returns for the post-closing period. But each of the purchaser and the vendor have some interest in those returns being prepared properly and accurately, and sometimes there's some decisions about what to include in those returns. So usually they're subject to a purchaser's right to review and comment, and then there's some room for negotiation around to what extent the vendor has to incorporate the purchaser's comments in the vendor returns, and if there's a disagreement, how will that be resolved? So again, this is a good place for the tax group to be paying attention, reading the provisions, understanding what's required and what their role will be in preparing these returns around for the pre-closing and post-closing periods. Really careful attention should be given to any elections that are required to be prepared and filed. It should be very clear who has responsibility for filing those elections and preparing those elections, what any elected amounts will be. And again, how will you resolve any disagreement about those elections, and do so in such a time that the election will be filed on time, and give you enough time to have that dispute. And finally, the purchase and sale agreement will typically include some language around how future audits and assessments are disputed, and how that dispute process will be managed. To what extent will the vendor have a right to control the dispute process? They're usually given the right for notification, but in your circumstances, you'll want to pay attention to these provisions and have them make sense for your particular facts. In a situation where there's a real disparity in sophistication, you may want to have more control, and you may want to just be providing notification to the vendor and maybe allowing some input, but you may want to hang on to more control as the purchaser in those kinds of circumstances. So again, it's just a matter, it's just a provision that the tax group should pay attention to, should get plugged into, and should be involved in reviewing. Okay, thank you very much. That brings it to an end for me, and I'm going to hand things over to Chris Montez, who is going to do our current topic for the day. Thanks so much.
Good morning, everyone. With the short amount of time that remains, I just want to give a kind of a high-level description of some transfer pricing developments that have happened over the past few months. And this is unrelated to the material that Matt and Erica covered up to this point in today's session. The first thing I want to do, just to set the table, is provide some background on the recharacterization rule in paragraph 247, 2B and D, and where the OECD transfer pricing guidelines have been going post the BEPS project, so after the base erosion and profit shifting project. And the real update I want to provide is on a couple of cases where there have been new developments in this area. And then I want to speak to what impact that might have on the upcoming federal budget. So just again, to set the table, to remind everyone, there is a transfer pricing recharacterization rule in paragraph 247, 2B and D. And it's paraphrased on the slide in a lot of words, but effectively it applies where you have a taxpayer and a non-arm's length non-resident person, and they participate in a transaction or a series of transactions. And in paragraph B, the condition is that the transaction or series would not have been entered into between persons dealing at arm's length. And ultimately, it's reasonably to consider that the transaction was entered into really for tax reasons. So if those conditions are met, then the minister can adjust amounts for purposes of the Act to the quantum and nature that they would have been if the transaction effectively was an arm's length transaction, so what arm's length parties would have agreed to, and the terms and conditions of that transaction were the terms and conditions that arm's length parties would have agreed to. So it allows the minister effectively to substitute a transaction as well as the terms and conditions of that transaction. By way of background, this recharacterization rule that exists in the Act was introduced into the Act shortly after the 1995 OECD transfer pricing guidelines were released. And the 95 guidelines and really, all of the historical OECD transfer pricing guidelines treated the recharacterization of transactions as an exceptional remedy. So it was very limited in scope. And our recharacterization rule in our Income Tax Act in 247(2)B and D had not been considered by the courts in Canada until very recently. And many of you have no doubt heard of the Cameco decision, and that was the first case in Canada where the courts considered this recharacterization rule. So we have 247(2)B and D in our domestic law, but at the OECD level, as I've kind of mentioned before, there have been changes. So the historical transfer pricing guidelines, recharacterization was viewed as an exceptional remedy. But after the BEPS project, there's been a real shift in transfer pricing, and the 2017 guidelines that were issued after the BEPS project, or in light of the BEPS project, reflect a really different approach to the recharacterization of transactions. And if you read the guidelines, it really does stand out that recharacterization is not really limited to an exceptional remedy anymore, but it's effectively done in the first instance when you, to use the language of the guidelines, accurately delineate a transaction before you price it. So there's much more of an emphasis that the OECD wants countries to place on recharacterization in the first instance. And so you have our domestic law, which is drafted based on an older version of the guidelines, which viewed recharacterization as exceptional, but you have the OECD kind of shifting, and really the CRA has been at the forefront of those discussions at the OECD. So they're very much in favor of this revised approach that's being advocated by the OECD. Everyone, I'm sure, has heard about the Cameco decision in Canada. It's been all over the media, and the real development, I suppose, for purposes of this session, this update, is that leave to appeal to the Supreme Court of Canada was denied in February 18th of this year. So that's a big development. And just to refresh people's memory, the case involved a Saskatchewan-based company. So the parent company is located in Canada, and they're basically a uranium company. And the transactions at issue involved the purchase of uranium, the purchase and sale of uranium by a European subsidiary of the Canadian parent. So at first, that European subsidiary was in Luxembourg, and then it was transitioned to Switzerland. And that Swiss sub purchased uranium both from Russia and from the Canadian parent at low prices under long-term contracts when the price of uranium was depressed, and then it sold it primarily into the US at increasing prices under shorter-term contracts as the uranium market improved. So it bought low and sold high, and therefore the Swiss subsidiary had considerable profit. And now the CRA reassessed the Canadian parent to allocate all of the profit of the Swiss subsidiary to the Canadian parent under the transfer pricing, among other things, under the transfer pricing recharacterization rule. And I won't go into all aspects of the case, but with respect to the recharacterization rule, the tax court said it didn't apply, and the Federal Court of Appeal agreed. And they basically said that the recharacterization rule in paragraphs 247(2)B and D only apply if arm's length parties would not have entered into the transaction under any terms and conditions. If it is something that arm's length parties would agree to, that rule simply can't apply. You just price the transaction in that case. So the court said the recharacterization rule doesn't apply. This is a transaction that arm's length parties would agree to, and therefore we just need to price it. The other case I want to just mention, and it came out last year, but it's very similar to the Cameco decision, is the Agri-City case. And it's actually a very similar circumstance to the Cameco case. And here we have a Canadian parented group of companies, and they wanted to buy and sell to farmers in Canada a particular herbicide. But under the regulatory regime at that time, they were not, a Canadian entity was not permitted to buy and sell that particular herbicide in Canada. So they were going to buy it outside of Canada and then sell it into Canada under a particular exception to the regulatory regime. So because a Canadian entity couldn't do that, they set up, at first a US entity, but then later on a Barbados entity to buy that herbicide from outside of Canada and then to sell it to Canadian farmers. And again, the CRA reassessed under the transfer pricing recharacterization rule, among other things. They reassessed the Canadian parent and allocated all of the profit, or attributed all of the profit of the Barbados subsidiary to the Canadian parent. And the tax court looked at that, Justice Boyle, and said, no, it doesn't apply. Again, following the reasoning in Cameco that arm's length parties would enter into that transaction at the right price. So the recharacterization rule cannot apply as a result. So both Cameco and Agri-City kind of agree. And now in Cameco, the Supreme Court of Canada has said, we're not granting leave to appeal. So the state of the law is favorable to the taxpayer in this regard. And as I say, it's not really where the CRA wants to take the law and the law of transfer pricing in Canada. All of that said, the Supreme Court's decision to deny leave is fairly recent, and we have a federal budget coming up on April 19th of this year. And in conferences and things like that, I have heard high-level CRA officials say that if they are not successful in court in Cameco, they could consider a legislative amendment to Section 247. So, I just raised the question: might there be an amendment to expand the transfer pricing recharacterization rule in this upcoming budget? I certainly think it's quite possible. So that's something to watch for. And if that does come through, that's going to change the landscape for transfer pricing in Canada. And we've discussed elsewhere in past presentations and in a paper we wrote earlier, some of the adverse effects of that, greater potential risk of double taxation where two different states can't agree on the same recharacterization or characterization of a transaction. So it could potentially lead to a lot more uncertainty in this area. So it's something to watch for in the upcoming federal budget. That concludes my brief update in that area. And I understand there are a few questions, so I'll turn it over to Matt and Erica to answer those. Thank you very much.
Okay, so I have two questions that I'll really briefly address. So the first one is in respect of my slide 15. If Target's no longer a CCPC, how does it still have a CDA? That's that example I gave with some planning that you can do, and on that bump up of goodwill, on the deemed disposition of the goodwill, there's a $50 addition to the CDA. So correct, it's no longer a CCPC. Again, it ceased to be a CCPC when the PSA was signed, but 251(5)(b) rights are not considered for all purposes of the Act. So in this case, the target is still a private corporation, so it does have a CDA balance at that time. The second question is in respect of the 110.1.1 election an employer can make. So it was mentioned that the employer needs to notify the employee in writing. My understanding is that the appropriate T4 reporting must be done, or can notification be done in another manner. Yeah, so the language in the Act is that the employer, once they make that election, they need to provide written evidence to the employee, and then the employee provides that to the CRA. Correct. This is done via the T4. That cash out amount is reported in box 86 on the T4, and then if the employee is taking that deduction, that's going to be claimed in box 39. I believe, and that's the convention, and that's what the CRA recommends doing. So for simplicity, it's done via the T4. So I don't think that there are any other questions. So thank you so much for joining us, and I hope you all have a great Tuesday. Thank you.